Mr. Weber, Germany had a bumper second quarter, and the Bundesbank has indicated that it's going to raise its forecast for growth to 3% from 1.9% for this year. What's the outlook for the second half of this year?
As you said, it was a almost stellar performance of the second quarter. We expected a strong second quarter, but it even caught us somewhat by surprise. In addition, the first quarter was revised up from 0.2 to 0.5, which basically has led us to the view that a 3% growth this year is possible. However, the second half of the year, we're going to see some moderation in growth. The current momentum is not sustainable. We will see weaker certain fourth quarter, but nevertheless around the ballpark number that we may have seen that we've seen in the first quarter. So overall, quite good, but weakening momentum ahead, which is in line with the global weakening of the momentum in some emerging markets and in the U.S. economy. So our outlook is, whilst we had a good performance now, we're going to see some more moderate growth going forward, and that's going to keep also inflation at bay. We expect inflation at around 1.5% for Germany going forward, growth at about 3%, moderating into next year. All in all, it's quite a good performance the German economy is still showing, even given these two sort of outlook weaker than current performance.
And how will that affect the outlook for all of Europe?
I think we're going to also see a somewhat higher projection relative to the previous projections for Europe as a whole. If you, for example, take the performance in Europe, including Germany, it was 1%. If you exclude Germany, it was 0.4. That has to be seen against a performance in the first quarter of 0.2. So Germany is going to have an effect on the entire European development, a positive effect. We may see some modest upward revision, not as strong as the one we've seen in Germany, for both this year and also to some degree next year for Europe as a whole, against the background also that Europe is going to have moderate inflation developments, not much out of sync with what we projected before, 1.5%. Price stability, moderate growth, that's our view for the next 2 years.
What about the problem now that you've got such divergent growth, strong growth in Germany, much weaker growth in some of the peripheral countries? How does this, is this going to present a problem for the ECB? For example, you're going to need different interest rate levels in Germany compared with, say, Spain or Portugal.
You see, it was a deliberate decision by the European governments to have a European monetary policy, so we as central bank can only look at the European average. Of course, this single monetary policy will have a differential effect on some of the performing economies like Germany who are running ahead and some of the weaker economies who are still bordering onto recession. And that is putting the ball firmly in the field of European governments, because national fiscal policy, industrial policy, wage policy, they're all still at the national level, and they need to focus on the problems that these economies face in making the single European monetary policy have a more homogeneous effect on their economies and on the euro area as a whole. So what they need to do is they need to foster growth, that is structural reforms in order to gain growth momentum, and second, they need to consolidate budgets. Both of these objectives have to be tackled at one time, and I think it is fair to say that the problems emerging from the divergence performance are not a problem for monetary policy, because we have a different mandate, but they firmly put governments on the spot to act decisively on both long-term reforms fostering growth and short-term consolidation, which I think has undermined some of the credibility these countries have in the market.
While they're doing their fiscal consolidation, that's going to depress growth in those countries. You're going to get an exaggeration of this divergence. Is that going to be an issue?
I think if you look at the action that needs to be taken, it will partly be helped by a weaker momentum of Germany going forward. So what we've seen in the second quarter helped us rebound, but let me remind you, Germany also fell last year by an unprecedented 4.7% in GDP, and we have now in Germany, with a very good second quarter, made up for half of that fall in GDP levels. We're not yet back to pre-crisis levels. Other countries, the southern peripheral countries, have not fallen as strongly because they're not as export-oriented and dependent as Germany. So they have a better ratio where GDP still is relative to pre-crisis level, and the main policy challenge for them, first things first, is fiscal consolidation.
And at the same time, your outlook for prices and inflation is still of price stability over the what period?
Well, we usually project 2 years out. We view that as the most likely policy relevant horizon, and all the information we have now and that we looked at the last policy meeting led us to the conclusion that interest rates are appropriate given the price outlook over 2010, 2011 and into 2012. Inflation is pretty much in line with our objective. Inflation expectations are well anchored, so there's very few signs of either a challenge to price stability or a credibility problem in view of our objective, the way market looks at pricing of index bonds versus normal bonds. So credibility is given, expectations are well anchored, and price stability is the most likely way forward.
We've just been through a pretty momentous financial crisis. Actually, I say been through. Are we out of it yet? What's your assessment of the financial crisis right now?
Well, I think it's way too early to say that we're out of it. We're not in year one after the crisis. We're in the fourth year of the crisis. And that warrants to be alert. It basically also requires that in addition to the main outlook that we just talked about, a moderate but nevertheless weak momentum in growth and price stability, that there are risks. And the risks are related to a weaker performance of the economy than previously expected, in particular in some of the peripheral countries where fiscal consolidations and weak fundamentals and low competitiveness interact in a very negative fashion. This is why policy turnarounds are needed. And on the way forward, also the discussion of whether the global economy is facing some stronger headwinds now. So there is a debate on not just a loss in momentum, but some likelihood of renewed recession in the global economy and in some of the major industrialized countries. I view that as a bit exaggerated, to be honest. I think the market is kind of overreacting again to some not so positive, but still not so bad news for the second quarter in some economies. The momentum is somewhat weaker, and in a cyclical pattern, the US economy, for example, has been leading in its cyclical recovery, the European recovery. So it was clear to us always that the growth momentum would moderate both in emerging markets and in the US. That will have an implication in the future for the way forward for Europe and Germany in particular. So benigner outlook than in the past. But let's not exaggerate. We're not facing major problems. The momentum, the recovery is going to stay on track. The IMF has projected a relatively robust global growth. International trade is back at double-digit numbers, probably. So all in all, the picture looks much more on the bright side than it did a year.
And so you're not really seeing any chance of return to recession?
Well, as I said, we need to monitor those risks. And those risks could become stronger if the markets increasingly view that outcome as likely. So it's very important to say we are fully aware that the most likely way forward is not the only possible way forward. There are risks on both sides. I view the risks as fairly balanced, a moderate recovery, but with risks on both sides. Some have been arguing that the strong momentum could be maintained in Germany. I'm not of that view. At the same time, I think the weakening of the momentum will not be such that we will move into new problems. It will be more moderating in terms of normalizing rather than anything else. So you have to look at both risks.
Looking at the financial markets now compared with where they were back in May, at the height of the crisis, they've calmed down considerably. Now, you had to sort of recourse your exit strategy earlier this year because of the Greek crisis. Is it time to actually start thinking about exiting from the ECB's unconventional measures?
Well, some of the exceptional measures we've again taken and installed are running out. Again, like the half-year liquidity provision. I don't think it would be wise to continue with these very long operations. The next issue we're going to face is what will happen to the 3-month operations and what will happen to the tender procedure in particular that we've embarked on. We are moving forward now to a period where for the 3 months operation, the end of year effect will become very important. That is usually surrounded by some uncertainty regarding the liquidity situation. And in my view, it would not be wise to change our operating procedures, not taking into account the upcoming end of year tension. So for the October operations, I'm very strongly of the view that we should maintain the current allotment mode, full allotment for the 3 months operation. As we go forward, I think there are good arguments to wait with the normalization, which we've always done step by step, of the tender procedures until the end of the year, not just covering the end of the year effect with the 3 months operation. So most of these discussions about continuation of exit will focus, I think, will be focused on the first quarter. And we've always said the exit from these measures is very state dependent. It will depend on the fragility of financial markets. There were some positive signs when the 12 months tender matured that the withdrawal of some of this liquidity was taken well by financial markets. The volume of the overnight markets and the 1 week secured markets has come up somewhat, and we will see how markets develop, and then we will take these things step by step in a gradual way, looking at the effects of the measures we've taken, how they are affecting financial markets. And if financial markets remain robust, despite the withdrawal of some of these measures, I think the issue will be on the table what measures to withdraw next. I think it's clear that we need to re-embark on a normalization procedures, phasing out the exceptional measures, but that will not be a time-dependent or autopilot-driven process. It will be very state-dependent on the health of financial systems and the banking system.
And so would it be until the first quarter that you also wait to decide about the whether to continue the possibility of purchasing government bonds?
Well, I think it is pretty clear that purchases of government bonds program has played a minor role only. There was a very modest number of purchases. What is happening is the market is repricing sovereign debt. And that new equilibrium is something where I think any intervention in the market can smooth out the transition to that new equilibrium. But the market has to find that new equilibrium, and it surely will be the case that the pricing of sovereign debt in some of the European peripheral countries will not be at the same level as the pre-crisis pricing was.
Speaking of the purchases of the government bonds, you were very critical of the purchases in public. In fact, some say you broke an ECB taboo when you came out and spoke so publicly about that. Looking back, would you change the way that you handled that situation?
Well, look, my views at the time were known. I'm not going to comment in detail on this issue, but let me say two things. What I said was two basic remarks. The first one was all of these purchases are not part of the standard monetary policy toolbox, and as such they entail risks. And I think it is very important, and I even said that 1 or 2 weeks before the decision, it's very important to keep a clear focus on what is the responsibility for monetary policy and what is the responsibility of fiscal policy. I think what happened over that weekend, fiscal policy took charge, and the SPV that is now created in Brussels takes the responsibility to help governments in funding needs. This was a key fiscal policy decision to be taken, and I very much welcome that decision. What role, in addition, central banks have to play in that? My view is secondary market interventions are possible, but they should only smooth out the transition to a new price equilibrium. And the second thing I said, we should keep this purchase program limited. I think the numbers we've seen so far are clearly in line with the view that it should not be a very large size program. It should be a limited and focused program, helping to smooth out the transition to the repricing of sovereign risk. In that sense, I think the program that we've embarked on, as it turned out, in particular in its later phase, had the right focus. Some of the initial attempts to try and defend the pricing of sovereign risk at levels which previously existed was clearly to take out some of the excitement of the market. It calmed the market, and you can argue long whether calming the market was more driven by our purchases or more by the creation of the Brussels vehicle. I don't want to go into that. I think the focus now looking forward is Let's keep this program focused on what it can do, take out excessive fluctuations, help markets find a new pricing equilibrium. I think it's doing that even with very limited amounts, and I think that's what we should focus on.
Mr. Weber, you're considered to be one of the front runners to take over the job at the ECB presidency of Monsieur Trichet. Given the controversy that surrounded your comments back when you were criticizing the bond purchases in public, do you think you're enough of a diplomat to actually have that job?
Look, we have a very good president of the ECB. He has more than 1 year of term left, and we should focus on solving the financial market problems that lie ahead. We should forget about these personal debates. They're not what is helpful at this stage. We're in year 4 of the crisis. But in terms of profiles for central bankers, I think it's very important that even in a crisis, central banks steer a clear course. In my view, it is very important that we keep the framework of monetary policy unaltered, or at least live a very strong commitment to go back to our regular policy operations in peacetimes. And I think it's very important for central banks to be clearly focused and also, if necessary, to deliver undiplomatic messages to governments. So in my view, it's important to be a diplomat for the diplomatic corps. It's not so important for a central bank. One of the central bankers I've always admired was Paul Volcker. You can call him anything but not a diplomat. So I think it's very important, central banks, to have a strong view, to basically stand for that view, and even if it means that sometimes to focus on what you need to achieve, and that is price stability first and foremost, that sometimes requires also to put diplomacy at the back seat and a clear focus and an outlook at the front. So I wouldn't necessarily subscribe to your job description.
Finally, would you like to be the president of the European Central Bank?
I have 1.5 years of my term left, and I would focus on my options at the end of this term. But until then, I will do everything that is needed to do this job well. Any action you take on this job, either action or not action, has long-term consequences. It's not worthwhile to consider those. It's important to focus on what you're doing and to do that job. That's my sole focus, and I'm really not looking at it.
So can you say, are you a candidate or not?
I am having a nice job here, and that's what my current job description is, and that's what I will live till the very end.
Mr. Weber, thank you very much.
Thank you very much.